From the morning reading, NASDAQ, Spiders, Dow Jones rally to new all-time weekly high close. Kraft Heinz, Celgene, Apple, Google lead the NDX. The broad indices paused compared to the prior session again on Friday before buyers stepped in and pushed the NASDAQ, Spider, and Dow to new all-time closing highs. Friday's move was led by consumer staples, technology, and consumer discretionary. On the S&P 500 snapshot, on Friday, the S&P opened lower than Thursday's close and was fairly flat until late in the day with a rise of a couple hours before the close. The index reached its intraday highs at the close and ended the day with a gain of 0.17%. Week over week, the index saw a gain of 1.5%, ending Friday with yet another record close. The U.S. Treasury puts the closing yield on the 10-year note at 2.42%, virtually unchanged from the previous Friday's close. In other reading, it's been a good idea to sleep in lately. The S&P 500 has shown a consistent pattern of weakness during the morning and strength in the afternoon. During the past year, the morning has added only 3 points to the S&P, while the afternoon has added 79. Tech stocks can't lose. The S&P 500 info tech sector scored its 13th straight gain on Friday, the longest streak since 1926. Yes, 1926, when streaks of 10 or more straight up days have ended and the sector was at an all-time high. The winning tended to reverse with mostly negative returns going forward. Nothing matters. In the recent tradition, as this is odd but nothing matters, the 10-day correlation between the S&P 500 and the VIX fear gauge is now positive. When the S&P 500 was at a multi-year high at the time, this has occurred since 1997, 13 times. The S&P was positive over the next month 7 times, averaging a plus 0.5%, but with risk of negative 2.2% versus a reward of plus 1.8%. And never underestimate the determination of a bull market. Since the November 8th presidential election, the Dow Jones has gained almost 2,300 points. This spectacular 11.9% gain was the second largest 14-week post-election rally for the Dow Jones since 1930 and has been accompanied by equally spectacular headlines. One can only hope that it's merely coincidence that the only larger post-election rally occurred in the 96-97 during the tech bubble. Healthcare Spider turns up. Healthcare equipment and medical device ETFs hit new records. Healthcare providers ETF touches a 52-week high. Biotechs and pharmaceuticals ETFs show improvement, but are healthcare laggards. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:09 a.m. Mountain Time, and I'm recording this in preparation for the market day of February the 21st, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into today's morning report. And let's see right here. And at the time of this cut, all 4 of the U.S. broad-based indices were up slightly, with the S&P, the Russell, and the NASDAQ all up about 0.25%. The Dow futures up a bit stronger at about 0.33%. Crude oil, fairly large move, up 1.73%. Euros down about 0.2%. Long bonds down about 0.33%. And gold down about 0.2%. And overseas action, looks like everybody was open that we follow. China up about 0.4%. Hong Kong down about 0.75%. Japan up almost 0.75%. Germany up over 0.5%, and the United Kingdom just below scratch. And macroeconomic reports for today for the United States of note. We have FOMC member Kashkari speaking. And that appears to be about it. Long list of things in overseas, but not much in the United States. Looking forward to tomorrow. We have existing home sales. FOMC member Powell speaking. FOMC meeting minutes. So a couple more important items on the agenda for tomorrow. In terms of current volatility conditions, short-term VIX very low, 9.03, skew quite elevated at a 141.13. IV percentiles extremely low, and the S&P at 11, the Russell 9, the Nasdaq at 0, and the Dow at 22. No standard deviation moves were put in on Friday on a close-to-close basis. Markets, of course, were closed for President's Day on Monday. So one thing to keep in mind is some data could be reflecting back to Friday's all market participants activity, and some could be looking back towards Monday's partial futures market action. So things will be a little screwy, a little scrambled today, perhaps in some of your technical analysis levels. Let's go ahead and take a look at the charts. And you see the recent breakout continues to build on the S&P. And you have, with the current overnight action, putting once again another intraday new all-time high. And if we were to close right where we are right now, that would also be a new closing high. So we seem to be building on the recent breakout. And the Dow, exactly the same story. Nasdaq, same story. And the Russell. Russell is the only one that is not participating in the extreme amount of recent bullishness. It's more of a sideways pattern in the recent several sessions. In other markets, let's take a look at crude oil. Now this is getting interesting in crude oil. Crude oil has spent over 2 months, really 2.5 months, I suppose, in a sideways consolidation pattern. And crude oil, if it were to close right where it is right now, would be a new closing high for the 52-week period. We did have an intraday high. It went all the way up to 55.24, and that would be the place to look for some resistance on this action. But we would seem to have a range breakout occurring right now on the crude oil market. In terms of gold, gold's also sideways consolidation. It had been the most strongly trending of the regular markets that we review, but it seems to have deteriorated into a consolidation pattern along with bonds. Bonds in a complex sideways consolidation pattern now for over 2 months. And then dollar. Dollar's a bit of a move. It's still in the clouds, so overall neutral market posture, but certainly a fairly significant move up today, and that may be very much what's going on behind the crude oil market. And let's see, we'll take a look at volatility. The volatility is currently right on the 12 threshold. So still in that very low volatility region, perhaps not quite as low as we've had in some recent trading sessions. So relatively quiet across most of these markets with some exceptions, especially crude oil and the dollar. And then also you got 3 of the 4 indices, everybody but the Russell, that are currently pushing this bullish breakouts further higher on the action coming into the market open today. We've got a little over an hour before the market opens today. We'll see what happens when the all participants join in. In terms of our daily report, the intermediate term phase opinion market phase 4, that is a bullish pattern, and we look for extension patterns in this part of the market phase. In terms of the three market timing signals, all three mechanical in nature, coming from three different systems. The first one from IBD, confirmed uptrend, that's bullish. GMI index, a perfect 6 out of 6. That buy signal now has been in place since 11:10. And the third one from Stock Charts Decision Point Scoreboard. This one is starting to truly line up, and that we're getting the stack of agreement between the short term and the intermediate term on all the markets, only waiting for this long term to join the parade. So that's the only stick in the wicket, as it were, right now. In terms of position sizing models, both models, the portfolio investor and the volatility active trader model, are coming in at 100%. In terms of the intermediate term market posture, an exceptionally strong bull, further supported by a strong bull sentiment line. And you see most of these values are coming in as high as they can practically be. The S&P at a 98, the Dow also a 98, and the NASDAQ at a 98. All of those within 2 points of the highest level that they could achieve. The Russell, also exceptionally strong bull, coming in now at a 93, so joining the parade there. In terms of the strength of trend, currently quite strong, nothing of concern showing up from that indicator. Hedge warning status 0+, normal with some elevated conditions, and that number of elevated conditions has been frankly dropping of late. In terms of the three strategy opinions, the first one, the VIX is below the acceptable range to initiate new positions for novice traders on option income strategies. But this is just, at this point, a bit of a asterisk. We've been oscillating above 12 and below 12, so we're certainly near the lower threshold where you get a respectable amount of premium compared to the amount of risk that you're taking on. Just something to kind of keep in mind. But we have been oscillating back and forth. Cover calls, put selling, no changes from last week. Still maintaining that in both these opinions that it's acceptable to initiate new positions, though being a bit of a stock picker, being a bit conservative in the ratio of in the money and out of the money strikes, given how extended we are, that we are indeed in market phase 4 in extension patterns. And, sometimes you can end up loading up into positions just to see everything finally correct. So be a bit selective and add a few at a time. And hopefully you've been doing that all along in recent weeks. In terms of specific areas of warning under the volatility area, most of this is about relatively low volatility and the expectation of expansion of volatility. We still have this persistent distribution day high count on the NASDAQ at a 5, and the skew, as we mentioned earlier, is really quite elevated. Above a 140 is a pretty significant level of warning, and that's running about a 13% probability of a 2 standard deviation move over the next 30 days. Into the trend-based area, everything is fine, and nothing there of concern. Intermarket risk aversion indicators. This is, in some, we call this probably neutral. We have 3 that are risk on marginally, if you were to look at the individual indicators. 1 that's just flat neutral, and 1 that is just barely risk off. So not a lot of clarity coming out of this set of indicators at this point. In terms of sentiment, intermediate term, we've got an 8 out of 10. In terms of the overall fear and greed index, you see we're at a 78, extreme greed. So keep that in mind. When we get up into the extreme areas, whether it's extreme fear or extreme greed, what we do at that point is we start to watch for signs of reversal pattern. We do not take action just because this sentiment index is in the extreme area. We just simply watch for other indicators to start to show that things might be exhausting. In terms of sector specific, you can see the winners on Friday: consumer staples, telecom, real estate, And utilities, all defensive sectors were all positive, and most of those, up at the upper part of the performance ladder. Whereas the more risk on, were by and large a bit more subtle, though nobody was particularly negative on the day. Energy was at 0.5% down, materials at 0.25% down. Pretty good breadth on Friday. Most sectors and most components within the sectors were positive. And in terms of the percent change, there's something missing in there. But anyhow, market posture by time frame. Mostly what pops out to us at this point is the relative weakness of energy, telecom, and to lesser degrees retail. Retail has been improving in recent sessions. And then in the most recent percent change, our market performance compared to our typical benchmarks now at 3 months, when we get this post-election period, we could see, all the sectors are doing well in that period. But for energy has been, after being so hot in recent months and recent weeks, has started to certainly cool down. Materials and financials also starting to perhaps slow down just a little bit in the shorter time frames. And the relative rotation graph, most of these have been markets that have been tailing off in their relative weakness. IYZ, certainly of interest, telecom, and then also note that these three here, which are IYR, real estate, utilities, and home construction, are starting to improve. They're starting to show up here in this upper left quadrant, moving towards the upper right quadrant, and they'll soon come onto the radar screen in a more proper fashion if they continue the kind of performance that they've recently had. Now, the interesting thing about these is that they are largely affected by interest rates. Interest rate sensitive industry groups at the very least. So there seems to be less concern in these industry sectors about the current environment for interest rates. Even though we've recently had Janet Yellen speak to the expectation that we could have an interest rate increase in the month of March, as well as that we would have 4 during 2017. So kind of interesting activity going on there. Okay, I think that's probably enough. Let's go ahead and wrap this thing up, get our week going. Hit the pause button if you see a slide that you've got an interest in more detail. Grab those hyperlinks for additional details on the website. Free trial information. Then, of course, the disclaimers. Hit the pause button if you need more time to read the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. We'll be back here next session for the Wednesday session of the market preview from Falcon Global. In the meantime, manage that risk profile and good trading.